Hi, Sandy Vicani, Insurance Agency Marketing. I'm a supervisor here at Producer Services, and just wanted to say thank you so much for taking time out of your busy schedule to attend just such a great webinar, such great information to learn on the private financing. Before I hand it over to our speaker, Anthony Lawrence, I wanted to go over a couple things first. Here at Insurance Agency Marketing, when you are a new producer of ours and start placing business, we say a big thank you with a new producer bonus. There's 3 different levels on that bonus system. First level is $100,000. So when you place $100,000 of business with us, whether it's life, annuity, MedSup, long-term care, you get to choose from a $750 cash bonus, a 2-year subscription to a website and newsletter service, or the latest iPad generation. If you produce in your first 6 months $300,000, instead of choosing those prizes at the $100,000 level, you would choose a $1,500 gift card, $2,000 of matching marketing money, or a full Social Security program with a 3,000 piece postcard mailing. So let's say in your first 6 months you're just doing great and you place $500,000 of business with us. And again, that's life, annuity, MedSup, long-term care. Combination thereof, you choose a 5,000 piece mailing in seminar coaching with Matt Gill, 4,000 piece mailing in seminar coaching with Dave Pimper, or a Ritz-Carlton travel rewards. It's make your own personal getaway, which is great. So if for some reason, you just don't have the time to, plan a trip, we will be happy to help you a little bit in that direction with that reward. For all agents, whether you're new or existing, we here at IAMS also have an agent trip that we sponsor. In February 25th through the 28th, 2018, it'll be at the Boulders Resort and Spa in Scottsdale, Arizona. Qualification period, we have long qualification period, started July 1st of 2016, goes all the way through December 31st of this year. To qualify for that, you would need $2 million in annuity premium, $1.5 million in single premium life. You could do $175,000 of life target premium, or $1 million in Medicare SUP, or $400,000 in long-term care premium. So this trip is in addition to any company's incentives or trips that they offer. We offer this as well. To help you on your creative side, whether you are starting out and you need just basic marketing, whether that's, building a brand, logo, business cards, any stationery or letterhead, we have such an amazing creative media team to assist you with that. If you'd like to go into more letters or mail pieces, any newsletters or custom projects, we're able to do that as well. Any basic online marketing, so if you have a website and it just needs to be revamped, or you don't have a website and would love to get one, we're able to create that and manage that for you, as well as an email newsletter service. If you're wanting something more advanced, with a website and email newsletter service, we can also do a paid search management. So what happens is for your area, when someone Googles life insurance or annuity, you would be pulled up first or in the top for the specific area. And we're also able to do online video ads, any radio ads, television ads. We're able to help create that for you and help with local channel deployment. So as you can see on our creative side, again, we offer a multitude of help here, again, from basic marketing all the way to television ads. I would suggest you contact either Josh or Jen in our creative department, and they can assist you further with that. Insurance agency marketing itself, again, we really believe in the email newsletters. 86% of the internet users, believe it or not, are 65 and older. They use email. If you don't have an email newsletter service, again, speak to Josh or Jen on that. It helps you with website lead forms. You can manage and organize contact database. You can send out, again, those email newsletters. It's a 30-day free trial for the newsletter templates. If you go ahead and give us a call, you can do that for 30 days free as long as you are contracted with us. We also carry and do, and this is, we are grateful enough to have Anthony, who will be speaking today, be one of our presenters at our IAMS Life and Annuity Academy. This is industry recognized, and while I talk about this, I am going to send out a poll question. If you could check yes on that, all you're doing is asking for additional information. And what it is, again, industry recognized, 2-day training, all expense paid trip for you to do sales ideas and strategies from top producers. We go over different indexed annuities, the threats, especially with the DOL and the different trends. We go over turnkey seminar systems, large life case marketing, again, wealth transfer tools, income riders, objections from clients and how to get over those. We have one coming up March 17th through the 19th. Again, all expense paid, so we pay for airfare, hotel, your food, all of that stuff. If you check yes, again, you're just asking for us to send you out some additional information on that. It's not signing up for anything. We had over 1,000 agents, want to attend this and ask to attend this last academy. We choose between 35 and 40. So again, please, if you're interested, just mark yes on that survey and we'll get you out some information. We also make it easy for you for paperless contracting. So when you contract with us, we send you out a universal contract. And what we do is, it's 4 pages. You circle the carrier or carriers you're interested in getting contracted with, and send that back along with your license, E&O, AML, all that other great stuff. And what we do is set you up electronically. So in the future, there is no additional contracting paperwork. You just give us a call and let us know, hey, I'd like to get contracted. And we go ahead and get that completed for you. If you'd like to just do it on your own, you log in, check the box next to the carrier you want to get contracted with, and that's it. So we try to make it as easy and seamless as possible here at IAMS to get you up and running with contracting. We also have a great website. If any of you have been on there, I encourage you to go back. It has been retooled. If you have not, the website is www.iamsinc.com. It is a great educational tool to use. It lists all of the current trends. It has an annuity rate watch if you're looking for current rates. You're able to run life quotes, get forms, look at all of our incentives. It's available 24/7, great industry links. Anything that you want to know about our carrier or about what's going on with life or annuity, you're going to find on this IAMS website. So again, I encourage any of you who have not already registered to register for the IAMSinc.com website. Because of all the changes with the DOL, IAMS is very excited to let all the agents know that we now have IAMS Wealth Management. And obviously, it's insurance-friendly asset management. It's built with the advisor, with you as our priority. We take on the burdens of doing all the new business processing and scrubbing apps, the portfolio construction. We do the compliance, asset management, and billing to provide you with more time to focus on what's really important, which is trying to get that sale, addressing clients' needs, gathering the assets, and acquiring clients. That's such a big role for you to do. We just don't want you to be burdened with the back office, which is what we would be happy to take care of. If you want to know more about our IAMS wealth management, our high payout rates, and how we can help grow your business, please give us a call. I'm also going to do a link on that. You can check yes for asking for more information. Or again, you can call 888-255-7670. And I mean, that's just even if you want to ask questions, what's trending right now with the DOL? What are what's exactly going to happen because of the new leadership we have in the United States as well? What have they come down with? So again, great information to get by calling or by checking yes on this poll question. So with that, a couple other things. We have a retirement analyzer. So this is planning software. It's developed by agents, exactly for agents. So you can, possibly increase your income and develop a repeatable sales process by simply filling out this form for clients to see. So, I mean, they ask, can I continue with my present standard of living in my retirement years? You may be able to tell them one thing, but actually seeing it makes a big difference. They like to know if they can retire safely. Are they going to run out of money? What happens to their family if they die prematurely or if they need to enter a nursing facility? What are the solutions if their situation changes? This puts it in graph form, in writing, in ways that your clients would be able to understand. It's a great tool to use. Again, give us a call and we'll be happy to go over that for you and get you some additional information. Any agent that is contracted with us, whether they're a new agent or an existing agent, if you refer another agent to us, to say thank you for that, IAMS will give you $50 once that referred agent contracts with us. Once that agent starts writing, you get 20 basis points on any piece of business that agent places from that point on. So if they, write a life or annuity case and they keep doing that, whether it's for 6 months, a year, or 10 years, you're getting 20 basis points as a thank you on each piece of business that agent writes. While we're giving you that and great incentives, if you're a new producer bonus, we're also giving you a marketing reimbursement account. And what that is for every $100,000 of placed business, we're putting in $200 of marketing money. So if you do seminars or you start a website and you have you've placed $100,000 with us and it's a $400 bill, we'll pay 50% of that, which is $200. We'll make the check right out to you. So again, another great incentive to get contracted and start writing business here with IAMS. At this point, I'm going to turn it over to Anthony Lawrence. He will take over and again tell you just the great, amazing information and as you as an agent can be just so successful in this private financing. So Anthony?
Thanks, Sandy. And just to clarify, I think you had said the training academy was March 17th?
It's May 17th, May 17th through the 19th. Sorry about that.
No worries. I was going to say I need to pack my bags it's March. So before I get started, I just want to say that Sandy and the team over at IAMS have been a huge asset for us at Wealth Insight. They always go above and beyond and have been a key component to our success. So if you're not using IAMS for your back office support, I strongly consider checking them out. So my name is Anthony Lawrence. My company is Wealth Insight, LLC. Quick background on me. This was my 17th year in the business. And a little over 6 years ago, I a book came across my desk by R. Nelson Nash called Becoming Your Own Banker. If you're on this call, you've probably heard of Nelson Nash, and you may even have read Becoming Your Own Banker. If you have not, my recommendation is jump out on Amazon and or go to infinitebanking.org, and you can pick up a copy there. That book was life-changing for me. I read it twice in one weekend. Actually called the number on the back, spoke to Nelson Nash's son-in-law, David Stearns, who directed me to one of the top private banking practitioners in the country, which was fortunately for me just in my neck of the woods over in the Kansas area. I'm out of Kansas City, and I studied under this individual for about 2 years, learned everything I could from him, and then went out on my own. And 6 years later, I transitioned my business from primarily all annuities to now doing what I do now, which is, and you've heard of it as the infinite banking concepts, becoming your own banker, bank on yourself. There's a handful of individuals out there who have tried to rename it. I use private financing system with my clients and prospects. You can call it what you want, but it really does follow a set of principles that most of us agree upon. Prior to using this concept, the only life insurance that I ever wrote was maybe a single premium life policy or a universal life policy, but never with the intent or knowledge that you can actually look at the living benefits, not just the death benefit of life policies. And that's really what this concept is all about. So I know a lot of agents, when I first explain this, whether it's at the academy or whatnot, they'll say, oh, so you basically just sell whole life insurance. And if you know anything about this concept, you know that it's a lot more than just selling whole life insurance. And as a matter of fact, for a lot of you guys who have done life insurance in the past, one of the things that I hear from a lot of agents is, that you stick with annuities because life insurance is such a pain because of the underwriting. It just takes forever. And this concept really helps with that because, and I'll get into it, but basically through underwriting, you don't just have to underwrite the owner. You can underwrite, an insurable interest. And really, if you explain this concept well to a prospect, the life insurance isn't really the sale. The life insurance just becomes part of the process. And when you implement it, it's the concept that you have to get the prospect to understand. And so building your client's private financing system. And Cindy, you guys can see the screen, right? I just want to make sure.
Correct. I can see it just fine.
Okay. So what we're going to talk about is what is it? What is the private financing system? How does it work? And why you should be sharing this with your clients. So the private financing system, what is it? I'm going to read this. The private financing system is a uniquely designed process that utilizes a properly structured dividend-paying whole life insurance policy to finance anything on which one spends money. Now, uniquely designed, this is not cookie cutter. When I work with someone, there's typically two types of prospects. There's two types of clients that I have. On one end, which is probably the type of client who's more, you guys would be more attracted to, and that's, this 60 and older. They've already sort of arrived where they are. They've got little to no debt, and they have some assets stored away in some form of a retirement account. And that's usually who we are attracted to because we want to move that money into whether it's an annuity or whatever it might be. And on the other end, someone that most of us try to really avoid is probably the working, still working and has debt, whether it's good debt or bad debt or a mixture of both. Housing, automobiles, some necessary debt at that time, or credit cards and student loans. So this system will work for both individuals from either a debt recovery perspective or a cash flow perspective. A properly structured, so this is, again, it's not cookie cutter. There are certain principles, principles that that we follow, but for everyone, it is not just something that you can set up and you can go to 99 out of 100 life insurance agents, and most of them are not going to know really how to structure these policies the correct way. And what do you do with the policy once it's designed, once it's structured? But one thing that I have found, that whether someone has a lot of debt or whether they have zero debt, one thing we all have in common is until the day we die, we all spend money. And this concept allows you to recapture principal and interest on the money that you spend. So I'm going to jump into, this is one of the presentations that I use. I've tweaked it a little bit for agents. So it would be a little bit different if I was giving this in a workshop or to an individual prospect, but because you guys are going to have a little bit more knowledge than the average person about life insurance. And again, you may have a pretty good understanding about this concept. So if you have any questions, feel free, type them in there, and then we can address those. But this is how I do it, and I love to educate. I love to teach, and more than anything. And so we'll kind of jump right into it, just to give you guys a better understanding. So how much are we really keeping? So let's just take an average Joe today. Somebody making, let's say, $100,000 a year. Well, today's average American is saving about 5% of their income. I think it's actually down a little bit from when I built this slide a couple years ago. Prior to 2008, it was in the negatives. And just to put it into perspective, back in the 70s, the average savings rate was about just shy of 15%. So what has changed? We can get into that. But if this individual is following suit with the average American, that means he's saving $5,000 of that $100,000. It also means that $95,000 of his income from January to December comes through the front door and then right out the back door. Taxes, housing, automobiles, debts, other expenses, it all adds up. And it's the way probably the majority of Americans, not probably, that is the way the majority of Americans live their lives. Money comes in and money goes out. And we don't really pay much attention to that $95,000 because it does what we want it to do. It buys what we need and what we want. So let's say this individual took that $5,000, and whether it was a 401k or whether he gave it to a financial advisor, and they put it in the market and he earned 10% rate of return, which is what everyone says that's the magic number. I know Dave Ramsey says you can earn this all day long, throughout your lifetime. So let's just say this guy does earn 10% on that $5,000. Well, in that year, that's a $500 gain. What I do with my clients is I say, you know what, that $95,000 that's coming through the front door and going out the back, what if I could show you and turn you into a prosperous Joe and show you how to recapture just 1% of that $95,000. I'll explain what recapturing means here in just a second. But if he could recapture 1% of that $95,000, that's $950. But when you look at that $5,000 of savings, and it took him 10% to get that $500 gain. I showed this individual how to recapture just 1%, and that's a $950 gain. And so when you look at it from that perspective, that's like a 19.5% rate of return on that $5,000 savings. Our clients on average, and again, it depends, where they are, but we do an analysis. Our clients on average are recapturing anywhere from 3 to 7% of their income within the first year. And that's huge. And, our goal is to get them to, look at 10, 20, maybe 30% of their income. Now, you can't do that overnight, but if you were bringing back 30% of the money that you spent each and every year into a usable account, would that change things for you? The average American today spends 34.5% of the $95,000 in interest alone. Now, you might initially think that's crazy, but look at an amortization schedule. If you've ever had a mortgage, what are we paying in the first 7 years of a mortgage? Pretty much interest, 80, maybe 90%. You add automobile payments, student loans, credit cards, it's not far-fetched, and we see a lot of it. We see a lot of 30 and 40% going to interest when we do our analysis for our clients. So we want to recapture where that money is going, and that's the whole premise behind becoming your own banker, is if you can recapture a third of what you're making, because it's going to interest alone, what would that do for your financial situation? And would you really care about what the stock market is doing, or would you really care about a rate of return? Because this concept really does shift the focus. It's a paradigm shift from believing that rate of return is important when we try to teach, let's talk about volume of return. So who really controls our money? Well, this Nelson Nash wrote, Becoming Your Own Banker. So if we believe that banks control our money, because what happens is we play two roles in banking. We play the saver and we play the borrower. And the bank is the one who controls the money, because what happens is, as a saver, we put $1 into the bank. Well, the bank doesn't just let that money sit there. What do they do with it? They loan it out to somebody who then pays back the bank, and the bank then gives us a fraction of interest on what we saved with them, just for the convenience of housing that money. But it doesn't just flow in that manner. What happens is if we understand that when we put money into a bank and the bank loans that money out, the individual that they loan that money out to puts that money to use. And let's say they go buy a car. Well, so when that individual has a cashier's check and hands it to another individual who has a car, they exchange the cashier check for a set of keys. Well, now, where does the individual who had the car take that cashier's check? He's got to take it somewhere. He takes it right back to the bank. So banks are recapturing principal and interest on other people's money, and they're making a wonderful profit in doing so. So let's just kind of play that out. And I'm not even really talking about fractional reserve lending, and that's because of the fact that they know that money has to be warehoused somewhere. It's primarily warehoused in a bank, but they can basically loan that money out over and over and over again, creating inflation and creating fiat currency. So that's a topic for another discussion. But if let's say we did, let's paint this picture real quick. So $10,000 into the bank that you've saved. Let's give the bank the benefit of the doubt and say they're paying us 3%, just for this example, or $300. So the bank is going to loan that money out to someone to buy a vehicle, and maybe they charge 6% or a $600 gain in interest. The dealership or that individual is going to put that money right back into the bank. So the bank gets to loan that money out to somebody else to do a debt consolidation and charge 7%. Let's go one more time and say somebody wants to do a home remodel. Well, the handyman, when they get that check, the handyman has to warehouse that money somewhere, so they put it back in the bank. So the bank is charged 6, 7, 8, or 21%, and that they're getting back versus our 3%. Now, on the surface, it looks like we could say that the bank made 18% more than what they paid the saver, 21% minus 3%. But that's not accurate, because if the bank only made 18% more, we made $300. 18% more than $300 is another $54. But the bank actually made how much? I mean, the bank, if you look at it, they made $1,800, which is a 600% profit. Take the 1,800 divided by the 300, and that's 600. And so they made 6 times what they paid us, and they didn't use any of their money to do so. So what we can do is we can basically control that environment by cutting the bank out as the middleman. That doesn't mean you're not going to use a bank. Obviously, banking for the convenience of online banking and swiping a debit card, it's not something you can do with an insurance company. However, if we can basically take the profit and we can recapture principal and interest on the money that we are using to buy the car, or to debt consolidate, or to do the home remodel, we're going to make that profit, not the banks. This is one of my favorite slides that I use. This is the cash or finance slide, and it really shows, and most people do not understand how money works. And so let's, again, paint this picture and say you were going to go out and buy a car. Now, most of your financial gurus will say if you're going to go buy a car, it's better to pay cash than to finance. And if you don't, and if you do pay cash, then you need to save up over the course of the next 4 or 5 years so you can pay cash for your next car. It's kind of the Dave Ramsey method. And so let's say that's what you were going to do. You were going to, you had saved up $30,000, and it's sitting in a money market account at a bank, and I'm the bank president. And so you walk into the bank and you say, Anthony, it's a great day. We've picked up the car that we want. It's $30,000. We've saved up enough money. I'd like to liquidate that money market account and go pay cash for this car. And I say, well, you can do that for sure, but what if there was a better way? What if you kept that $30,000 and put it into a CD with me at the bank? And it's a 4-year CD, which is about the length of a car loan. And I'm going to pay you 4% interest on that CD. And by doing this, I am then going to use that $30,000 as collateral, and I'm going to give you a bank loan. And it's a 4-year loan, so you got to pay me back. And since I'm paying you 4% for your money, I got to make some money, so I'm going to charge you 6%. And if you do this, you will actually make money. Now, would you believe me? When I was first shown this, I didn't believe it. But when you do the math, so the $30,000 4-year at 4% interest CD, at the end of that 4 years, your money will have compounded and grown to $35,196. So you would have earned $5,196 of interest. Now, obviously, with a bank loan, you're going to make payments back to the bank, and over 4 years at 6%, we would think that it's going to be more. It has to be. But in reality, you've only given up $38.18 in interest back to the bank. So by doing this scenario, you would have pocketed $1,378. So instead of using cash, you actually leveraged your own money, borrowed against it, and walked away with an additional $1,378. Now, how is that possible? How can you earn 4%, be charged 6%, and still walk away with a profit? And when I do this slide for my clients, it really is amazing. I would almost say maybe 1 out of 1,000 has ever, known this, that compounding interest, wrong way. Okay, there we go. Compounding interest with the $30,000 CD, after year 1, you're not earning 4% on just $30,000. You're earning 4% on $31,200. So your interest is compounding. You're earning interest on interest. Whereas over here, this is a decreasing amortization. So part of that payment to the $30,000 bank loan is going towards principal. And since it's a 4-year loan, actually the majority of it's going towards principal. And after year 1, you're not paying 6% on $30,000. You're paying 6% on just under $23,000. So it's a decreasing amortization. Isn't that amazing? You can actually change this 6% to 8%, keeping this one at 4%, and you just about break even. So what we say is, what if there was a third choice? Because back here, you did give up interest. You did give up $3,818 of interest. So what if we said, you know what if you created your own banking system and you warehoused that $30,000 in a system that you owned and that you controlled? So $30,000 is accumulated in your own private financing system, and it's time to buy that car. So you borrow the money out just like you would a bank loan. And you borrow out from your private financing system the $30,000. And let's just mirror what the bank was going to charge you and say you're going to charge yourself 6%. I recommend charging any loan I take, and I've taken several loans from my system, I charge myself a minimum of 10% interest. And you might say, why on earth would I charge myself interest? Well, it's a principle called economic value added, EVA. There's a lot of books on the topic. Nelson talks about this in his book. Economic value added, in simplest terms, your money has value. If you were going to borrow money from a bank, they are going to charge you interest. If you were a lending institution and you loaned money to a friend or for a business need, you would expect for them to pay you back with interest. So the principle is basically, why, when we buy things with cash, are we not treating our capital as if it has value? And if you do so, your pool of money will forever increase. Now, understanding this concept, we are using a properly structured dividend paying whole life insurance policy. So what that means is as we pay ourselves back from borrowing that money, we recapture the $38.18. Now you might say, well, wait a minute, part of that 6% is going back to the insurance company, because this is the primary key in using this system. When you borrow from your life insurance policy, the cash value, you're not actually withdrawing your cash value. You're borrowing it. You're leveraging against it. So your $30,000 actually stays put inside your account and continues to earn dividends and interest. So the insurance company is loaning you from their pool of money. They do not care if you ever pay that loan back, because you have purchased an asset, and that asset is a death benefit. And if you never pay your loan back, they know all they have to do upon death is subtract that from the death benefit value for your beneficiary. And the insurance company has got it figured out. They know that everybody dies eventually. So this is a no-risk loan, basically, to them. So by having that $30,000 and you pay back the 6%, yes, there is an interest rate that the insurance company charges you. However, and I've run the numbers, and you can see for yourself that as a dividend-paying or participating insurance company that is a mutual insurance company, through the dividend, you actually recapture that interest. Now, it's not the same dollars, but the money that goes back into your account, and I'll show you some illustrations. If you get a hold of me afterwards, we'll go through some illustrations that actually prove that you get back that interest that you pay. And if you use it wisely and loan it to your business, you can actually deduct that off of your personal, take a deduction from your personal account. Now, you recapture the $38.18. Again, the $30,000 never left your banking system. And let's just say it did earn the 4%, and it actually earns the $51.96. Just like you would have in that bank CD. Because when you borrowed this money from the bank, who kept the $38.18? The bank did. In this situation, you actually keep that. So you get to keep both the $51.96 and the $38.18. And 4 years later, you have a paid-for vehicle and about $39,000 of liquid tax-free money sitting in your account. Now, if you paid premiums into this policy, you have even more. But minus the premiums, have you recaptured all of the principal and interest on the car that you just bought? And you've got a tax-free bucket of money that you can go out and you can buy a bigger car next time. So often the question next is, well, how do you build your own banking system? So if you understand banking and understand a mutually owned dividend-paying whole life insurance policy, you'll understand that the insurance company and the banks, they basically they mirror each other. Nelson says you can take the executives from the bank and executives from the insurance company, and they could swap roles for 6 months and they wouldn't know the difference. So if you're going to build your own banking system, what does that look like? Well, we don't have to go out and actually get chartered by the government to start our own bank. We don't have to go out and construct a building. We don't have to hire the help, and we don't have to advertise. All we have to do is plug into a mutually owned dividend-paying whole life insurance company. And by doing so, let's just look at, I'm going to use small numbers because I like to keep the math simple. And let's say in year one we put $1 into our banking system. Well, immediately, the way we design and structure our policies, you would have about 57 cents available to leverage from that dollar. That's not bad, because we purchased an asset. What did we purchase? We purchased a death benefit that says if something happens to me or something happens to you, your loved ones are going to receive a 4,000% return on your investment in year one. Or if you continue to live, which is probably what's going to happen, you're going to create a legacy for your loved ones, which is pretty awesome. So we had a pretty good first year. Year two, we put $1 in. This is our premium. And we can leverage out about 60 cents of that dollar. So it's getting a little bit better. Year three is really kind of the turning point. You put $1 in, and you can actually leverage 90 cents to $90 to $1 of that dollar that you put in. So business is getting better. And in year four, when you pay your premium into the whole life policy, when you put that $1 in, you can leverage that dollar right back out. So really the cost from this point going forward, there is no cost, because you've just created your own, basically, banking system. Because when we put $1 into a bank and we withdraw it to buy something, we do that every day. What if we switched gears and started using a life insurance company to do that for us? Well, what would happen is in year five, when we pay that $1 premium, our cash value actually exceeds what we put into it. I'm 6 years into this concept, so I paid my 6th premium on my first policy. I have 8 policies. My oldest is 6 years. So when I paid my premium on that 6th policy, or on that first policy, the 6th year, I put $1 in, and my cash value grew by $1.23. How would you like to have your bank say to you, hey, if you keep banking with us, 6 years, every dollar you put in, it's going to make $1.20 or $1.25. On my illustration for my first policy, in my 10th year, when I put $1 in, when I pay my premium, my cash value will grow by about $1.65. How many of those do you want? I want, and that's why Nelson says it's not. It may sound crazy, but eventually you want to get to a point to where all of your income equals your premium. Where does all of our income go now? It goes to a bank, and then we withdraw it. And we lose the opportunity to ever earn interest on that money again. Well, if we switch gears and we put our income into our life insurance policy, we're borrowing that money out to buy the things we want and need to cover our expenses. Well, that means that money is still in there continuing to earn interest. Very powerful. So on the recapturing your debt side, and this is extremely powerful, and this will allow you to shift gears, because like I said, the majority of us, we want to work with 60 and older. We want to work with people who have the assets already accumulated. But I love working with 25, 35, 45-year-olds, because I can show them, if they're disciplined enough to save, I can say, you know what, let's take that savings or that dollar and let's put it in, and we've got the 57 cents in year one. Let's say you've got a Visa debt. You owe Visa 57 cents, and you're paying them a nickel a month. Hopefully that makes sense to you guys. It's just relevant to add a couple zeros in there, and you'll get the idea. But if you're paying Visa a nickel a month and you have access to 57 cents, what we suggest is don't actually pay off that debt. Purchase that debt. So in Visa's eyes, yes, it's paid off. But if you're going to become your own banker, you're going to become the lending institution. So if you've bought that debt at 57 cents and you've been paying a nickel a month, we recommend to do what? Obviously continue paying that nickel a month, but now you're going to direct that payment not to Visa, you're going to direct it back to yourself. And let's say you did that for 10 months and you put back 50 cents. Well, in year two, when you put $1 in and you've got 60 cents available out of that dollar, guess what we get to use again? We've recaptured 50 cents. We get to use that 50 cents again. Now we have access to $1.10. And maybe you have a car payment. You owe $1.10 on that car and you're paying 10 cents a month. Well, again, we're going to take that $1.10 and we're going to buy that debt. You're going to take that 10 cents a month for a year and put back $1.20. In year three, we put $1 in and we've got 90 cents of that dollar available. We get to use that $1.20 as well. So we've got $2.10. And let's just say since you started your own business, you had some inventory that you took a loan out on and you owed the bank $2.10. Well, we're now the bank. So we're going to become the lending institution. We're going to go out and buy that debt that you were paying 18 cents a month on. That's $2.16 over the course of a year that you've recaptured. So in that fourth year, when you put $1 in and you've got the dollar available, you actually have a total of $3.16. So let's review the numbers. In the first 4 years, how much money did we put into our banking system? We put in $4. How much were we able to actually withdraw? $6.93. I'm going to go back. When you add up the $3.16, the $2.10, the $1.10, and the 57, it's $6.93. That's $2.93 greater than what we put into our system. Did we work any harder or change our cash flow at all? We didn't. That $2.93, if we did not implement this system, would have still gone to Visa, would have gone to the car payment, and would have gone to that bank loan for the inventory. All we did was just redirect the flow of money. So how does it work? We use a mutual company, not publicly traded. There's a handful of mutual companies out there. There's really not too many of them, but we recommend definitely using a mutual companies. As owner of the policy, you want to have a say in the dividends. You want to have a say in where their money is being invested and how it works. So direct versus non-direct recognition, you may or may not even know what that means. Basically, non-direct recognition means that when you take a policy loan, the insurance company, the easiest way to describe it is they do not recognize the fact that you took that loan, so they will continue paying you a dividend as if you still had the money in there. Direct recognition does change that. Now, there's pros and cons to both. Typically, I prefer non-direct recognition, but does this work with a direct recognition company? It does. And there's certain things that they offset each other. Direct recognition sometimes has stronger guarantees, and if interest rates were to go up, they're more likely not to fluctuate the interest rate on the loan. Paid-up additions rider, that's how this works. It's properly structured. We use paid-up additions, especially in the first 4 years, to really catapult this and allow the cash value to grow. Rather than, we don't focus on the death benefit, we focus on the financing needs. So properly structured policy is going to have a lower death benefit than otherwise because the majority of the money is actually going into the paid-up additions rider. And we create a policy that is just to the right of the MEC line, the Modified Endowment Contract line. I'm sure most of you understand what that means. If not, we'll have a side conversation and I'll explain more about that. IUL or UL, so I know universal life policies, especially the index universal life policies, are more attractive than whole life insurance, but really what they're designed to do is focus on death benefit and just strictly cash accumulation. But if you really understand how those contracts work, they're variable contracts. Now, I'm not talking about variable universal life. I run from a variable universal life. I don't sell those. I do sell ULs and IULs, but not for the banking purpose. If you're going to create a policy for someone to become their own banker, we strongly recommend you stick with whole life insurance because it has guarantees tied to it. The last thing I would want is for one of my clients to be 90 years old, borrowed out every dime from their policy, and now their cost of insurance is through the roof and they can't afford to make the premium payment, and their policy implodes, and now there's a tax consequence. I'm not going to do that, and I don't recommend you do that either. Now, I'm not saying ULs or IULs don't have their place. I think they're great for cash accumulation. Again, this is a concept that will work for anyone, but it's definitely not right for everyone. And I say that in the academies a lot, that I'm not opposed to annuities. I'm not opposed to ULs or IULs. If we meet with someone and we find out that they're not a good candidate for this concept, and they just need to, reposition those assets into a properly structured annuity that works for them, then great. Or if they don't really want to become their own banker, but they like the idea of a potential tax-free supplemental retirement, then an IUL might be a good fit. This is a concept that takes discipline, desire, and determination. And so it will work for anyone, but it's definitely not right for everyone. And you've got to be careful when you offer this to your clients, especially existing clients, and you really want to make sure that they're going to, if they're going to borrow from their policy, that they're going to pay back the system, or else it could come back and really implode on them, and by year 3, they'll be very discouraged. So what I'd like to do, well, let's go over the benefits. Prior to that, what I'd like to do is actually go over, I'm going to pull this up here, a case study. This is an actual, these are actual clients of mine who have implemented this concept. And this is what I usually do for most of my clients. We create either a debt recovery analysis or a cash flow analysis. So this is pretty interesting. I'd like to go through this real quick and explain to you sort of how we would create a policy. So let's take Mr. and Mrs. Jones, 56 and 50. He's 56, she's 50 years old. Their combined income is about $120,000. They are business owners, and so they're kind of behind the 8 ball on saving. They just recently, for about the last year, really aggressively started contributing to an IRA, to a SEP IRA. They were putting $2,400 a month into that. So really all they have accumulated at their age is about $54,000. Had about $20,000 in savings. Now, Mr. Jones had a Prudential policy that he'd had forever, had $19,200 in it. They both had term insurance, $500,000 death benefit each. If you can see on hers, it was $561 because whoever sold that to her sold her a return of premium. So it was a 30-year policy that she was paying $561 a month on. So what this was their debts. This was kind of a snapshot of what their situation looked like. They had a first and second mortgage, 2 car loans, a credit card balance, and then a student loan for one of their kids. And we like to break down what their payment is and how much of that payment is going to interest. And you can see right here under the first mortgage that 67% of the payment is going directly to interest. And then it breaks down from there. So their current outlook $120,000 after taxes, the IRA contributions. They're working with about $76,590 of after-tax dollars. Well, I love showing this to my clients that of the $76,590, that $49,000 is committed to those third-party debts, about 65% of their income. Of the $49,000, that $17,700 is going directly to interest, and that's 23%. I said the average American is at about 34.5%, so they're actually under, but still 23% of their income is going just to interest payments. So if this payoff plan continued to completion and they paid off every last debt over the next 28 years, about $494,000 of their income would be transferred to a third party. About $150,000 of that would go to interest. So we make recommendations, and we also we guide them along the way. And this is especially for them. They're now in their third year. These are real clients of mine. They're in their third year, and they're actually doing better than what we originally proposed. But when we signed them up, we made darn sure that they were committed to this, because there was a lot involved, and if they didn't stick to the system, this would not work for them. But anyway, going down the bullet points, using $45,000 of that existing IRA money, pretty much liquidating that out, which some people might say that's crazy. Most financial advisors would say that, you know, don't listen to me. That's the craziest thing you could do. You're going to pay taxes on that. You're going to give up all that interest. But we recommended using the $45,000 to put a $30,000 annual premium on Mrs. Jones and a $15,000 annual premium on Mr. Jones. The reason we did that mainly was because he was older, plus he's a tobacco user, so we wanted to put the majority of it on her. Plus, we replaced her term policy, as you can see down here on the fifth bullet point, because we covered enough death benefit through her policy to where we were able to redirect that money. But anyway, I convinced them to stop putting the money into their 401k or their SEP IRA. I'm not a big fan of qualified money, and I won't get into that, but we can have a side conversation. I'll explain to you. I think it's a huge destroyer of wealth. I think it's one of the reasons why our savings rate went in the 70s from nearly 15% down to the negatives back in 2008, is because qualified money. Now, does it serve a purpose for the right individual who is not disciplined enough to do this on their own and just have the money come out of their paycheck? Sure, there's a place for it. But between taxes, fees, inflation, and market volatility, I think it's a huge destroyer of wealth. And I think the only people who really profit is the people who work on Wall Street. So anyway, that's my little rant on that. I can get more into it, but read Barry Dyke's The Pirates of Manhattan. It's a great book if you haven't read that. But so we immediately borrowed $21,000 from their policies, and we purchased the credit card debt. So they were paying $775 a month on that credit card debt. They're now able to redirect that money along with the $2,400 a month back into their own system. Again, I already talked about the term life policy. We canceled that policy because we replaced her life insurance with enough death benefit. So now she was used to paying that $561. We continue paying it back to herself now. Borrowed the remaining $2,800 from the system, and I also had them borrow $10,500 from his Prudential policy. I didn't replace the Prudential policy. It was old enough to where it was efficient, so we just used it as a part of their banking system. But by doing so, we bought his car. We were able to redirect the $395 automobile payment back to the system. So in month one, we've recaptured $34,500 of debt, redirected $4,131 per month of income back into their system. This will allow them to expedite their debt recovery, and also it gave Mrs. Jones a $762,000 initial debt benefit, and Mr. Jones an additional $195,000 benefit to the term insurance, to the $500 that he already had. Now, I don't just put those numbers out there and say, believe me. I actually prove it. And this is a template that we use. It's not, don't let it overwhelm you. Basically, up on the left-hand side, this is 12 months. This is year 1, and then it goes down to year 2 and beyond. Policy outlay 1, $30,000. Policy outlay 1, $15,000. This is the cash value of the loan that they're able to take. So they were able to take $23,892 of cash value. They were able to borrow that out, which bought the credit cards and, with that Prudential policy, his truck, redirecting the $4,000 back into their segregated account. And that's just a checking account that they use at their bank that they were putting the money into. Look what happens after year 1. There's $49,572 sitting in there. Is that enough to pay the premium on policy 1 and 2 in year 2? It is. So we pay the premium using this $49,000. It leaves us with an additional almost $5,000 plus what we can borrow out. We now have $29,000, nearly $30,000 available, and we're able to recapture the next debt, which increases what goes to our segregated account. Instead of $4,131, we're now putting back $4,887. A year goes by, we've now got $58,000 in here, more than enough to pay the premium in year 3, plus what we borrow out, which is greater. We've got $54,000 that we're able to borrow out. Notice, if we continue doing this, the number gets bigger, and in 4 years and 3 months, so in the 5th year, in the 52nd month, we actually are able to purchase the very last debt, which is their mortgage. Now they're putting back $7,080 a month that was going to all of those debts. It's now coming back to them. And again, we don't make that up. I mean, basically, this is her policy. This is her illustration. $30,000 contract premium. Total surrender value is $17,396. You'll notice that it's only $16,572 that she borrowed out because the interest was taken out already. So this already has the interest factored in. This is a great tool. When I show this to one of my prospects, this along with the actual cash flow, and I show them what the results are, very, for the most part, most people say, where do I sign up? And they don't even care about the life insurance policy because it's the system. It's not about the product. It's about the process. Just going here on these bullet points, in 4 years and 4 months, all third-party debt is recaptured. Now, there is a $165,000 loan from their private financing system. And if they don't pay that back, they're going to pay interest on that. So let's say they want to pay that back. Well, with $7,000 available per month cash flow, it'd take them about 2 years to pay that off. And that means in 6 years and 4 months, all of that debt is paid off. They've still got the $7,000 per month cash flow. Her policy went from $700 and I think it was $81,000 to, well, combined, it's $1,178,000 of death benefit. And there's an additional $209,000 of tax-free cash value available for business expenses, cars, vacations, anything and everything. By using this, they will have saved over $107,000 in interest payments alone. So now going back to the benefits to you guys, this is a great reason to get in front of existing clients, and you actually now have a reason to talk to kids and grandkids. Your clients who are 65, 70 years old, really, we might meet with the kids or grandkids just to let them know that, hey, we're here. This is what we've done for mom and dad. But now you actually have a reason to get in front of the kids who are in their 30s or 40s and share this concept with them. I've written several policies just by doing that. Commissions are great. Now they are structured a little bit differently because we don't take the full premium amount and buy a very large death benefit. We're only taking about 30 to 40% of that in purchasing the target premium. Your commissions are lower. However, like I said, I started off with 1 policy. I have 8 of them now. I have clients who have 6 and 7 policies that have been doing this, for the last 4 and 5 years because they're actually recapturing money and using that to purchase additional policies, which is what I just talked about. Renewal income, it's great. I mean, I think this year I'm probably going to make about $60,000 or $70,000 just in renewal income, just for them paying their premiums. It's fantastic. You have me as a resource. More than anything, I love to educate. If I could just educate on this concept all day long without everything else, I would do it. It's a passion of mine. I'm very passionate about the concept. It works. I've proved it to myself and to many others, and I love teaching this concept. And it's through education, through case design. And so a lot of times agents will get a hold of me and they'll say, well, you have a presentation, you have certain things, can I have those? Can we, how do I get those? What do I need to do? And so what I offer is, I offer case studies and separate analysis examples. I have done so many different analysis on this. I've done, okay, do you really recapture principal and interest? What happens if you don't ever pay the interest versus paying the interest? What does the policy look like? What happens if you never pay back the loan versus paying back the loan? What does this look like versus an investment earning 5% over a 50-year time frame? I've done so many different analyses, and it really is amazing. I have all of them, and they are available to you guys. That pre-formulated debt cash flow analysis Excel template that you saw, it's very powerful. You would have access to that. The complete PowerPoint slide presentation. What you saw here is just a fraction of some of the slides that we use. We use a lot of other good slides. It really just depends on who we're talking to. Ongoing education from the Wealth Insight team. Like I said, there's 3 of us who are very knowledgeable about this concept. And again, I've spent many, many hours with agents, educating them and teaching them really how this works. We're getting ready to do some videos that we're going to throw up on our website and have available to you guys as well. Maybe some audios so you can listen to them in the car, because I know that helps me out a lot. We do a lot of workshops. We're getting ready to do one next week exclusively for chiropractors. I'm really excited about that one. And so we do then workshops, numerous workshops, and they really do work. It's just a matter of making sure you do them the right way in front of the right audience. And access to our direct mail marketing pieces that have worked for us. And so just email and call me. The pricing information, honestly, it really depends on what you want to accomplish. Not everyone wants to use everything, so you just might want a little bit of education. So give me a call, seriously, or shoot me an email. I'd love to talk with you guys and explain to you a little bit more about how I run my business. And from there, I guess, Sandy, we want to open it up for questions if there's any.
Sure. Yeah, and again, Anthony is a great resource. He is a top producer industry-wide, goes on several trips with different carriers due to his success as well as ours. We're extremely fortunate and grateful to have him do this workshop. Again, he is open to assisting you. Of course, we're here as well. So just thank you again, Anthony, for sparing your time. So greatly appreciate it. So the questions that we have one question here, and again, everyone will get a copy of this webinar, this recorded version. It'll have Anthony's information on it as well as IAMS. Again, if you could let us know, Richard is asking again, can we use an IUL in place of a whole life? If so, what changes need to be made? If not, why won't that IUL work? So could you, he came in late, if you could just kind of re-answer that again.
So my advice is, if any of you guys have written IULs, or if you have one on yourself, or the next time you write one, read the policy, read the contract from start to finish, and you'll notice there's a lot of moving parts. There's a lot of could change, might change variable components to those policies. There's even some out there that if you miss a premium payment, your secondary guarantees go away. And the main reason I don't use the IULs is because there really is no guarantee on the performance, and you could miss out on, like I said, I mean, you know, I have a policy, I have a whole life policy on my daughter, my youngest, that I took out when she was 5. She's 9 now. I took that policy out on her when I was 35 years old, and I said, yeah, I wonder what this thing looks like when she's 35. So 30 years into the future, every dollar she puts into that policy grew by over $4. And why would you want to jeopardize that or give that guarantee up? So, but the main reason, just to answer the question why I don't use the ULs, is because the way I teach this concept for the right person, and not everyone, but for the right person who has the discipline, desire, determination, really to make this thing work, I'm not having them pay back their loans. I'm having them pay back the system. That means their loans are going to stay open, and they're going to continue paying interest on those loans over the years, because they're going to basically, their cash value is going to grow greater than the interest that they put into it. But they're going to pay back their system by purchasing additional policies. So what would happen is like I said, if your client is, I just went and visited some clients of mine. They don't do this concept. They're old annuity clients of mine, but my goodness, she is 96 years old. And just a couple years ago, she sold her Mustang because her husband said it's too dangerous. I don't know if this woman's ever going to pass away. I mean, it's remarkable. And I know you guys have clients or family members just like that. Well, I don't want a 95 or 96-year-old who has zero cash value, and their term chassis UL policy is now, the premium is astronomical, and they, for some reason, don't have the money to pay for that, and that thing implodes on itself, which we've all seen that happen from some of these policies that were written, you know, back in the 80s and 90s. And they've borrowed out, let's say their premium was, you know, $300,000 over the years, and they've borrowed out $800,000, and the policy lapses. Now they have a $500,000 taxable consequence. I'm not doing it, and I would strongly recommend you not to. So from the banking perspective, and you can look at all the top guys out there who do this concept from, you know, all the different carrier companies, and even they're going to tell you the same thing. Very few use the IULs for the banking concept. There are individuals out there, and I know that there was a lot of talk last year. There was a certain guy, I'm not going to name his name, but I had a conversation with him, and he blew it, in my opinion. But it was really discouraging. He basically did a webinar through his company that said that this concept is a scam and how IULs work so much better. Well, the entire presentation was based upon accumulation. It had nothing to do with banking. Yeah, from an accumulation perspective, an IUL potentially could, you know, beat the pants off of a whole life policy. But if you're banking with it, I like the guarantees and I like the steady growth. So that's why I don't use IULs.
One more question. So Don is asking, can it be used for young physicians to pay down their student loans earlier?
Absolutely. You betcha. We have several clients in the medical profession. I was just talking with one the other day. They have nearly $300,000 in student loan debt that they've actually, over the last 5 years, have aggressively paid down to just about $60,000. And sure, I mean, you can use this for anything on which you spend money on, because the number one principle above anything else is that we finance everything we buy. I'll say that again. We finance everything we buy. We either borrow money from someone else, a lending institution, a bank, a credit card, and pay back that financial institution with principal and interest, or we purchase something with cash. And when we pay cash, we give up the opportunity. So you're either paying interest or you're giving up interest. And as I proved in that slide with the cash or finance, that when you pay cash, it's actually greater what you're giving up because of the compounding interest effect. So you bet anything and everything, any third-party debt, and not just third-party debt. So if you've got a 65-year-old out there who has no debt, but they love to take cruises or buy cars, or let's say they've got kids and grandkids who all, want to buy cars. What if grandma and grandpa became the lending institution for all of the vehicles that their kids and grandkids buy? So now kids and grandkids are making their car payments back to grandma and grandpa. Now, you might say, how would that benefit the kids or grandkids? Well, what happens when grandma and grandpa pass away? That legacy comes right back to them. So, and think about that from a 70-year-old perspective. What if you had 6 or 7 automobile loans out to your family, and you had 7 $500 monthly payments coming to you? Would that increase your supplemental retirement income? Would that give you a cost of living raise from your Social Security? Sure it would.
Okay, well, again, thank you so much. This webinar will be sent out to everyone who has registered. Questions on this, Anthony will be more than happy to answer those at 913-707-7177. Here at IAMS, we will be more than happy to address those questions as well at 800-255-5055. I hope everyone has an outstanding week. Thank you for your time. Anthony, thank you for an amazing webinar. So greatly appreciate the presentation. And again, thanks for everyone's time. Bye-bye.
Thank you. Bye-bye.